Guys, we have three crises on our hand right now here in America. And America and investors are not used to this. And that is why it could be so dangerous for the economy. You see, the economy can usually deal with one crisis at a time, but we dealing with three. We're fucked. The best way to think of the crises right now is a food pyramid. At the bottom, we have the energy crisis with oil and liquid natural gas from the Iranian war. This is getting the most attention right now because due to the Strait of Hormuz being basically shut down because Iran won't let any boats through it, this is causing oil and liquid natural gas prices to skyrocket. This is also increasing the risk of cost-push inflation and increasing the fear of stagflation, where we see consumer spending and job growth start to decline while inflation is increasing. But I won't go too much into the energy shock. If you want to know more about it, go watch my last video. As we see on the food chain, it's the largest part, so it gets the most attention, but it's the least likely to have a major impact on the United States economy, at least alone, which moves us to the middle portion, AI. Now, the fear around AI is it's going to take everybody's jobs. Most recently, Jack Dorsey and Block laying off 4,000 workers due to AI and automation. Now, employees of Block said that AI cannot take their jobs away. And so actually probably what's happening is these companies, including Block, are saying AI are taking these jobs to make their stakeholders less worried and have their stock rise when actually they just overhired and they're laying off people because they aren't making as much money. But there is a real chance that AI can potentially take jobs in the future. So this creates an uncertainty about how production is going to happen in the future. The main fear we need to have is when it comes to the investment in the AI and these data centers that we have seen recently, because tech companies are investing billions of dollars into AI right now. And the fear is another dot-com bubble where these internet companies were highly overvalued and then all of a sudden they pop. And when people started to realize this and recognize this, their stocks fell sharply, and so this sent the economy into a frenzy. That's the fear right now with AI, that we're having an AI bubble, because 40% of the S&P 500 right now is taken up by 5 tech companies, and they're spending their money with capital expenditure for AI because they believe AI is the future. And it's the second most plausible cause for economic recession. But then we move to the top, which isn't getting the most recognition, but has the most potential to cause an economic recession. And that is the potential private credit crisis. So private credit is when private companies loan mid-sized, small businesses money outside of the banking system. But ever since the 2008 financial crisis, we have put hard restrictions on banks when it comes to lending money. But that's where private credit comes in from private companies. Companies like Blackstone, BlackRock, Apollo Global, Ares can give money and lend money because they aren't a bank, so they don't have this restriction, so they can lend more risky businesses money. They can give them more money, but they can charge a higher interest rate. So these businesses are taking the money that they're gaining from insurance funds, pension companies, and wealthy investors, and then lending that money to other smaller businesses. And this is making these smaller businesses highly leveraged. We don't like leverage. Bro, what the fuck is so many birds out today, gang? What the hell? My God, just chirping away and shit. And ever since the 2008 financial crisis, private credit has boomed. There is a $1.7 to $2 trillion right now globally in private credit loaning. But the problem with private credit is they loan at higher interest rates. And these interest rates are floating. And so when interest rates increase, the interest rates on these loans that they give out also increase. So the payment for a business that is getting credit from, let's say, Blackstone doubles because interest rates are doubling. And so these interest rates are going so high that their payments and their loans are literally doubling with that. And so that's why Bloomberg pointed out that private credit is the underlying issue with America right now that could lead to a recession that a lot of people aren't talking about. And one thing they pointed out is when borrowers struggle, sometimes these loaners don't declare the struggle as a default. And so this is called extend and pretend. This prevents funds from having to term losses immediately, but it means problems will accumulate in these portfolios quietly the longer that this happens. So why could this cause a crisis? One is liquidity. it's hard to transfer these loans into actual hard cash in a fast time period. So if these investors that invested into this company want their money back, it's hard for this company to provide that liquidity fast. And so that's why companies like Blackstone and BlackRock put a 5% limit on the money that you can take out immediately. But if more and more investors continue to ask for their money back that they invested into the company, we're going to see a real liquidity crisis and liquidity issue when it comes to these private credit companies. Another big issue is concentration in investors. If investors are seeing that these private credit entities are struggling, they might not invest as much. And this is going to cause a credit crunch because they're loaning out the money, but they're not getting money to provide these loans. And third, and probably the biggest thing, is the lack of transparency that private credit has. You see, it's not regulated by the SEC or the FDIC. And so they can say or do whatever the fuck they want. Basically, they can give out as much money as they want at whatever interest rate they see fit and not be penalized for that. But this lack of transparency starts to question how much money do these entities actually have at their disposal if investors are asking for their money back. So private credit becomes dangerous not because it's already collapsing, but because it's large, it's tied to high amounts of debts, and these debts are to companies that aren't as sufficient as a normal bank that is regulated would actually loan to. So just imagine the sequence. We have a geopolitical shock that raises oil prices, which is going on. And so we start to see rising inflation that causes stagflation in the US economy. Interest rates start to go up and remain high to fight against this inflation. Then corporate borrowers struggle to pay floating rate loans from private credit because interest rates are so high. And so suddenly, many of these companies lose access to financing. And this will cause layoffs, one, because they aren't getting funding, two, because consumer spending is down due to rising inflation. We'll also start to see bankruptcies and investment cuts as well. Then shock spreads through the economy. We see a large pullback, and then we have a recession. And this is coming. If everything stays on track as it is, a recession is coming for you and everything you love, and for me too. So let me know your thoughts. I would love to know what you think. Did I miss something? I will read all your comments. If you leave a comment, maybe not, I don't know. And I will see you in the next one, gang.